Hey everyone, it's Imran back with another macro options spotlight. Okay, US stocks gave back some of their rally last week. Obviously, a strong week in the end, still finishing up. S&P 1.5%, Nasdaq 3.5% higher. But we did see the debt ceiling negotiations kind of break down again, as we kind of thought they would. And then markets pulled back a little bit. Yellen also made comments about the banking sector needing more consolidation, which spooked the regional banks. They dropped another couple of percent on Friday. We did see gold recover as well on the back of the debt ceiling negotiations having a stumble. Gold had a tough week. Obviously, some crowded long positioning within the gold market that's been coming in, and that kind of needed a bit of shaking out. That's kind of what we're seeing. Not quite sure that's complete yet. There may still be some more downsides coming gold, so watch out for that. And then in other commodities, energy commodities did better. You had oil up around 3%. On the week, and then NatGas up 12, having another stellar week. NatGas now up 30% from its lows, but 20% in the last 2 weeks. The dollar did close the week higher. Liquidity looks like it's set to turn lower after the debt ceiling. Further issuance expected to build up that TGA account. Therefore, other parts of the market are going to suffer as money gets drained out of the system there. That's the theory. Looking at skew, equity skew was softer on the week, but does remain elevated in SPY and Russell for the debt ceiling still. Once that, that's not going to go away until this is resolved. Nikkei skew was hammered though. That was really, Nikkei vols exploded higher by about 5 vols as the market was up 5% on the week. So really decent week there. Japan catching a proper bid after, remember, Warren Buffett bought it and endorsed it. It's really starting to get going. The skew got hammered down to near neutral, which is down about 2 points on the week, and that's in the 0 percentile now, looking back over the last year and a half. Metals skew in terms of commodities was also softer in general. And then we had NatGas skew a little bit firmer, which is surprising given that it's up 20% in 2 weeks. You would have thought call skew would go bid. The fact that it isn't, and the fact that there's still a put skew, is quite interesting. Maybe that's a sign that this rally may be a sucker's rally. I guess we'll find out. Okay, in terms of implied vols and carry, generally seeing lower implied vols across the board with a few exceptions. We had Nasdaq vol relatively flat on the week versus other equities that were lower. We had Nikkei vol, like I said, exploding 5 points higher. And then in commodities, we had about a 5 vol point pop in NatGas vol as well on that rally. So while skew isn't really going towards the calls anymore, the implied vol is rising as NatGas is moving a bit more. Looking at the carry side of things, we are seeing most things in positive carry in the equities land, except for China still, which remains negative. In commodities, we've got copper and silver in negative, which means they're moving around more than their implieds, whereas we've got positive carry in the likes of in sort of most of the pairs. We had bonds in positive carry, as weakness has been quite orderly in the bond market, has been going down. It's been going one way, but it's been going relatively slowly. And then in sectors, we've got a positive carry everywhere, but the big one is XLV that really can't move right now. Okay, so that's kind of the summary. Looking over at charts and things that we're thinking about for this week ahead, debt ceiling negotiations obviously broke down. Markets are going to be watching for any more hints of a deal or no deal this week. Personally, for those that I've seen this before, I was trading in 2011. For those who have seen this movie before, like me, we'd expect there to be a lot of noise, but nothing really, no real clarity until the last minute. Last minute is being touted as kind of early June, so 1st of June, something like this chart. This Pepperstone put out this timeline here, which you may want to refer to for the debt ceiling. But basically, sometime in early June is when something probably will have to get resolved. If we look back at kind of what happened in 2011, markets sold off aggressively actually after the compromise was reached, but the US debt was downgraded after so much kind of toing and froing and what, all the noise they were making. And then the market really started to accelerate lower. Recent moves in the bond market and the dollar suggest that investors are getting a bit sort of more nervous about this rollover in liquidity and this TGA needing to be rebuilt because they're running out of money in that thing. And so if we're going to get a load of bond issuance, that's why bonds have been quite heavy to kind of anticipate that. But because we haven't issued such large amounts of debt in a while, so that's taken this thing out of QT. And this is something my friend Darius talks about over at 42 Macro. So, if we do get a load of bond issuance, then you're going to actually see more impact of QT and yields may still go a bit higher. That's the idea. And equity markets have been much more sanguine about this debt ceiling concerns, largely due to the fact that large cap tech stocks have been rushed into because people are desperate to get exposure to this AI revolution that's going on. So you can see positioning in NASDAQ is quite pumped right now. So as people talk about S&P futures having crowded positioning on the short side, well, they're forgetting S&P is like your hedge against everything else. And if NASDAQ futures are quite stretched on the long side, people may be running long NASDAQ, short S&P type trades to get tech exposure. Okay, something to be aware of. And we did see a load of call options as well being bought in the NASDAQ over the last sort of week or two, showing people are chasing that move. Okay. Now, with futures positioning crowded potentially on the long side, with sentiment quite stretched in terms of AI optimism, the darling of the AI sector, NVIDIA, is due to report on Wednesday this week. So we actually think that's going to be one of the most important events of the week, given that the AI stocks and the tech stocks are driving so much of this rally. You're gonna want to see how NVIDIA trades after these earnings, because there's a lot of froth being built into these earnings and these multiples in these names. And we're still pretty unclear on how these guys are going to go about monetizing this stuff, and who the winners and losers are going to ultimately be. Okay. And Jim Bianco talks a lot about, this is similar to the .com sort of frenzy and boom. Remember what happened to the likes of Amazon, right? Amazon clearly ended up being one of the biggest winners in terms of online retail when the internet revolution was happening. But that stock lost 94% in short order, from that original top that it made, right? Around $200 back down to $6 or something it was. Okay. So, anyway, just bear that in mind. These names have got a lot priced in. People have been chasing them. And when they need the exit door, there might not be one. Okay, so that's what you want. And therefore, if you are concerned about that and you've been lucky enough to own these stocks, then thinking about stock replacement strategies before earnings might make a lot of sense. You might want to roll into some calls or call spreads rather than just hold your stock position if you've had it for a while, because my God, that stock has had a proper run, right? NVIDIA. Okay, anyway, enough about that. What else am I looking at? So we've been talking about NatGas for a while. We saw the NatGas skew turning. We saw the markets kind of consolidating at the lows in NatGas, and we sniffed out the idea that it was going to rally. Okay. Now, if the thing about NatGas, it's a major input into fertilizer. Okay. And remember, the fertilizer stocks went crazy last year when the whole Russia-Ukraine conflict kicked off. You saw this parabolic move up in the likes of Mosaic, which is one of the big fertilizer names. So these things were rallying because NatGas was re-rating so much. Okay. And therefore, people couldn't afford to buy as much NatGas for production. Therefore, production of fertilizer went down and prices went crazy. Okay. Now, these stocks did top out. So Mosaic topped out in April, which was about 3 or 4 months before NatGas prices actually topped out. And NatGas prices, were being held up a bit by what was going on in European NatGas as well. But the point is, they pulled back a lot. You've got a textbook correction here, sort of an A, B, C type move right into Fibonacci support at around $34 in Mosaic. It's also sitting on the 200-week moving average here as well. Something flagged on Real Vision on the daily briefing on Friday just gone. So this is a potential entry point. You've also got some bullish divergences on the momentum side. This is on a weekly chart. So again, quite a lot of technical signs that this might not be a bad entry point in the stock. And you've got NatGas that has just rallied 30% off its lows. And we know that these things often do kind of track what NatGas does if we zoom out a bit, right? So we're thinking it's not a bad stock to play. And then we obviously go to the vol space to see, well, would you do anything in options, right? If you didn't want to necessarily own what is potentially a volatile name, I mean, it dropped 10% on earnings just gone in May, right? So these things know how to move. Is there anything you can do in options? So looking at the options side on Mosaic, the implied vol has been trading down pretty steadily over the last few months. It got up to about 45 implied, down to around 38 right now. Realized vol, the stock has obviously been moving down, right? So you've had the stock move down significantly, but the vol's been coming down with it, which is interesting in itself. The value of the calls that I'm looking at, some September calls, have kind of shaved a lot of value in the last few months. And they're not worth a lot. They're worth about $0.50 or just under $0.50 right now. If we look at the 10 delta upside on 3 month, just that floating implied vol, we can see it's in the 3rd percentile. And it's also lower vol than the realized right now. So realized vol's at about 45, implies at around 37.5 on these upsides. Okay, so we think there's a pretty good case to be built for owning some outright calls in Mosaic, longer term, maybe 3 to 4 months, if you think this thing can turn and give you a bounce, right? Looking at the stock, you can see we don't need, on this chart, on this weekly chart, if we got to bounce back to the 50% retracement, that's already a 20% rally, right? So remember, when you zoom out and you see these levels, that's not a bad scenario to be able to own some outright calls for a 20% rally, okay? And in 4 months, that gives you plenty of time for a name like this to actually do that if NatGas prices can stabilize. So that's what I'm looking at. All right, that's it for today's one. Thanks for listening, everyone. I'll catch you all tomorrow. Cheers.